What is going on, traders? You guys left me a ton of comments last video. I asked the question whether you guys would be interested in a series called TA Tuesdays or TA Thursdays, where we go over a technical analysis breakdown of the markets and look at some more of the technicals as opposed to these broad-based market economic overviews. And a lot of you surprisingly were interested in the technicals. So this is the first edition of TA Thursdays. I'm going to be doing it sometimes on Tuesdays, sometimes on Thursdays, sometimes both, but you will see the number in the parentheses in the title. Likely it will be called like TA Volume 1, TA Volume 2, Volume 3, something like that. Anyway, so here is the first edition of TA Thursdays / TA Tuesdays. Let us get right into it. Today is September 8th, so why don't we take a look at what the markets are doing? Looking at the SPY. So first thing I want to point out, and by the way, we will go over different factors as well. I'm going to be looking at options flows, the US dollar index, bond yields, bond yield inversions, everything that will affect the market. The FOMC watch tool, we're going to be taking a look at a lot of economic data that comes out in conjunction with technicals. So don't worry, I won't leave you hanging. We will still go over that stuff. So looking now, the market is seeing a technical bounce here. Now, why do I say this? Well, easy. If you draw a fib from the bottom, the most recent bottom to the most recent top, you'll see that we are currently at a 0.68. We stopped at the 0.68 fib level, right? That is not surprising. We've seen this time and time again. We saw this back here as well. So the 0.618, 0.65 fib level, this is called the golden pocket or GP. This is, if you don't know about this, then make sure that you add this to your Fibonacci. The way that I do it is I go into settings. 0.65 is not going to be there, okay? 0.65 is not going to be there by default. You actually have to add it. So you would click a box. Let's just pick a random box, one of maybe the higher Fibonacci levels, and you would type in 0.65, and it will then calculate it for you. I have it here already. The 0.618 is already automatic, and I just unchecked the 0.786, the 0.5, the 0.236, because I don't need to really just bloat my Fibonacci's, and that's all I care about here, right? Is the GP, because it is the most key level, especially when we're talking about technical bounces. We use the Fibonacci on day trades. We also use the Fibonacci on long-term technical analysis. So you could see that the S&P 500 right now is bouncing from that, that GP, that golden pocket level, and we are currently down from highs. We're not quite in bear market territory anymore, because we are only down 16.5%. A bear market, remember, is a drawdown of 20% or more. Now, the Nasdaq is still in a bear market, and we will go over the Nasdaq after this. Now, we've been monitoring this fractal for months. This is the reason that we took an optimal short of the markets here. And for those of you that are in the group, you know that we shorted this in a multitude of ways. We also shorted a bunch of common stock. We shorted Tesla, we shorted Apple, we shorted the triple Qs. I have puts on the Qs. Now, I'm wondering whether I should close my position or not. And by the way, if you guys want access to all of our trades, the shorts, the hedges, you want access to the day trade watch list, our day trades, our futures trades, which we recently got the group into futures, and everyone is excited about that. If you want access to all that stuff, including the day trading course, the options course, the Zoom calls with me, check the link in the description. We just opened up spots for September. Would be happy to have you. So apply and make an appointment with one of our ambassadors. Okay, so that is why we shorted the market here. Now, in terms of where the market could end up, this really depends on external factors. Why do I say that? Is this just a technical bounce here, or are we actually going to see the market go back to these recent highs that we saw in August and then all the way back here in May? It really depends on what CPI comes in at, which is September 13th, and it depends on what the Fed does September 21st. Now, if you take a look at the FOMC watch tool, you'll see that now it is 86% priced in that we do a 75 basis point rate hike, 75 to 100 basis point rate hike. This was on the lower end. There was a higher probability at one point that we did a 50 to 75 basis point rate hike. Now it's 75 to 100. And this is after basically we heard from Jerome Powell today as of the time of this recording. It wasn't an FOMC meeting. It was just a follow-up meeting to what we call the FOMC Beige Book, basically just a pamphlet of economic data talking about the different Fed sectors or the different Fed geographies and how the economy is performing in each of those sectors and how the economy is performing overall. Anyway, but basically all the Fed members, including Jerome Powell, reiterated that the Fed has to be strong in fighting inflation no matter what. That is why you see this at 86% here. So in my view, it would be very stupid for the Fed to do a tepid rate hike of 25 basis points or 50 basis points. They have to do 75 to 100. And just hiking into an economic slowdown in general, I would be still bearish on the market in that regard. The reason I would be bearish if the Fed still has a lot to hike is because we are still in a very negative territory as far as the federal funds effective rate is. That is the rate minus the CPI. We're still at negative 6.8. And in every other high inflationary period in history, we've only gotten out of it when the Fed actually raises the Fed funds rate above CPI. So if you think of the CPI right now is at around 8.5, let's just say the federal funds rate is at around 2.5. Well, if you take the federal funds rate minus CPI, you get -6. So essentially CPI has to be trending down and the Fed funds rate has to be trending up in order to get to a point where inflation has come down so much and the rate has gone up so much that now the rate is above CPI. And once we get above that point, then we can start talking about when the Fed is going to likely reverse policy and do a pivot and stop raising rates, or worse, even cut rates, right? But it really all depends on how fast inflation comes down, which is why that September 13th date is so important. All right, so what else? Now, here from a technical standpoint, if we just take aside the September 13th CPI data and we take aside the Fed meeting on September 21st, if you look here, you'll see that we have what is called a fair value gap. Now, for those of you that are new to TA, fair value gaps are instances in which there are inefficiencies or an imbalance in the market. Basically, it is marked by an impulsive move, and on the way down, you take the low from the candle before the impulsive move and the high from the candle after, and you have what's called a fair value gap. Now, initially in traditional TA, we tend to look at actual gaps like this one, but fair value gaps, time and time again, if you take a look at the data, you'll see that fair value gaps also have validity in terms of getting tested or getting filled, right? So in this case, the technical bounce here can really grab liquidity at this level, at this imbalance level. And this is where we would likely see a first major test. And this would coincide with September 13th with the CPI data. Now, if inflation is trending down heavily, meaning we get a print that's significantly below 8.5, then I think the market can go back and retest these highs at around 430 on the SPY. Again, we'll talk about the Nasdaq in a second. However, if inflation is comes in as expected or even higher, then I think this will be a major point of resistance for the market right here. Somewhere between 400 and 415 on the SPY. And the SPY is really respecting these golden pocket levels. If we draw our fib line back at this fractal, where we created a very similar pattern to what we saw, in July. If we look back at the March fractal, you'll see that after drawing our fibs, the market started dropping, and then we saw a bounce. We saw a bounce into what? Into that golden pocket, before then dropping further and making new lows. And lo and behold, we also had a fair value gap here. If you guys want me to do a tutorial of how to spot those, I mean, there are tons of them online, and this is not an original idea. I didn't create the fair value gap idea. It's been around in Forex for quite some time. There are some very prominent traders who I think this is attributed to. I'm not sure exactly who it's attributed to, but this is something that's been around for a while, particularly in the Forex community. But as I said, if you go back and backtest it, there is true validity to it that, these impulsive moves down or up are actually imbalances or inefficiencies in the market. And we do end up going back to retest them just to clear that imbalance before moving down again or moving up again if we're talking about an up move. So, very similar here. We have the golden pocket, we have a fair value gap as well. And so I would not be surprised if this is actually where we stop, somewhere around here, as I said before, between 400 and 415. Also, it's important to note September is and will always be the worst month for stocks. Historically, it has been just absolutely terrible if you compare it to the other months. It has the lowest average return. The average loss in September has been 0.7% negative when we're talking about the S&P 500. The worst month ever, going all the way back to 1931, and also 48 of the past 96 Septembers have suffered losses, contrasted to other months that had positive returns 63% of the time. And if we take a look at the shorts data here, I'm using Cheddar Flow. By the way, if you guys want a discount on Cheddar Flow, make sure you use the code TT32 at checkout for a discount. But you will see here that most of the big block orders today, the blocks and the sweeps, were all taken up by puts. And we have almost a 60-40 bearish to bullish sentiment on the SPY. And if you take a look at these orders, this is just huge. We're talking about almost $20 million in bearish plays open just today. And the expirations are really targeting this, September down month. You see expirations in September as well as in October. There are a couple in November and December, but most of them are September and October, targeting that historical bad month in September, and also targeting this technical bounce here. Now, if you take a look at the Nasdaq, and by the way, I think the Nasdaq is actually at a decent buy point for the long term, or dollar cost average point for the long term. Remember, you want the dollar cost average on the way down, not dollar cost average on the way up, especially if we're talking about blue chips and indices. But if you take a look at the S&P 500, we're still down almost 27%, 26.5%. Not quite the technical bounce that the S&P 500 saw, and we're still very much in bear market territory, which anytime the Nasdaq or the S&P hits bear market territory, if you bought it, chances are you will be significantly up 12 months later. So the Nasdaq, it is a large index as well, one of the two largest indexes, the other one being the S&P 500. So, it's not surprising that it has completed a very similar fractal to the S&P 500. So again, down 27%. If we take our Fib tool and we look at where it's bouncing off of, this stuff it's not rocket science and it's not magic. It is really just proven market theories over time. So you'll see that we're bouncing right off of that golden pocket as well. And if we go back and take a look at when the Nasdaq recently broke market structure, and we take this low and we take this high, you'll see that, back in January, the technical level that we saw a bounce from was that golden pocket as well. So do we have a fair value gap on the Nasdaq? Yes, we do. If you see this impulsive move down here, if we take the low from the previous candle and the high from the candle that's succeeding it, you'll see that this is around the fair value gap here. So the Nasdaq can actually move up to around the 310 to maybe 315 at the high level in order to test this inefficiency or test this imbalance once again. I would not be surprised to see that. But again, just like the S&P 500, it coincides with the CPI data on September 13th. And then we'll see there. If CPI comes in significantly lower, I expect to hit these highs once again at around 333, 334. But like I said, the Nasdaq is down 27%. Anytime it's down almost 30% and you bought it historically, you've been a buyer in your long-term portfolio, then you've come out winning. So I don't mind buying or dollar cost averaging in the Nasdaq at the moment. And in terms of a pattern, you can see that this is clearly a falling wedge. It's very similar to the S&P 500. We didn't draw that pattern but it is very similar. You have this falling wedge here where you're continuously creating lower highs and lower lows. So, until we break out of this wedge, if you guys want a sort of, like those bowling lane barriers, what do they call them? Bumpers. If you guys really want these bumpers in order to base your trades off of and look for confirmation of whether we broke out of the pattern that we're in or broke out of the downtrend, this is what you want to draw. This is called a falling wedge. Now, falling wedges, eventually, they do tend to break to the upside, right? But it has to be tested multiple times before that happens. And obviously, the market conditions have to be right for that to happen. And we likely have to get more buy side volume. I just don't think that aside from a better than expected CPI, I don't know that there are many other catalysts ahead in the short term. And if we take a look at the Nasdaq, it is even more shorted than the S&P 500, almost 70 to 30. And if we take a look at the premiums here, there is just some insane sell side premium on the S&P on the Nasdaq. We had one big order block coming in for 11.3 million in puts, and if you take a look at the order details, you'll see that it was near the ask price. Anytime you get ask price or above ask price, it means that the market makers or institutions are rapidly buying those puts because they are willing to pay ask or near ask, right? But you have these big block orders and big sweeps here on Nasdaq puts, again expiring around that September-October timeframe. Not surprising, being that institutional investors are likely, basically they trade the trend, right? They don't fight trends. So if most Septembers show that the market is negative, well, they're going to take that bet each and every time. You want to put yourself in the best position as a trader and an investor to win. And you don't do that by fighting trends. You do that by trading the trend every time. You won't be right every time, but if the trend upholds most of the time, like it has historically, then you are actually trading the right way. You're trading with the algorithms, with the trend, as opposed to opposing it or against the grain. And if you look at the US dollar index, we are currently at a 20-year high. The last time we were here was back in 2002, almost exactly a year ago now. Yeah, I mean, this is the US dollar currency index is the US dollar versus a basket of world currencies. So right now, the US is actually doing much better economically than the rest of the world, even though it might not seem like it to the average American. But if you ask the average Brit or the average German, the US is actually doing really well compared to Europe and the UK. And that's reflected in the US dollar index. And the more that this goes up, the worse it is for stocks, right? The more that the Dixie goes up, the worse it is for stocks, because the US dollar is getting more expensive. And that also means that multinational companies that have interests abroad, their profits and the revenues are dropping because of the exchange rate. And lastly, let's take a look at the bond yields. You can see that the 10-year is back well above 3.3. We're at 3.323. And there are inversions between the 10-year and the 7-year, between the 10-year and the 5-year, the 10-year and the 3-year, the 10-year and the 2-year, which is the big one. Even an inversion between the 10-year and the 1-year. And you can see now that we're getting close to an inversion between the 10-year and the 3-month, which has always signaled a recession up ahead. There's even an inversion between the 10-year and the 6-month, meaning the 6-month is paying more than the 10-year. And the reason this happens is because bond investors are fearful of an upcoming recession, and they're fearful of inflation. And so they don't want to lock up their money in the short term. So what happens is those bonds sell off, the short-term bonds sell off, or they're not bought at auctions, and everyone is pouring into the 10-year bond because they want a longer exposure to interest rates versus, one that is short-lived. Who knows after 3 months or 6 months what the economy is going to look like. So you don't want your money tied up in short-term bonds. That is why those aren't being bought up in the short term. And when bonds aren't being bought up, and or when they are sold heavily, the yields tend to go up in order to attract investors once again. But once we get that the inversion between the 10-year and the 3-month, which you can see here, hasn't inverted yet, but that is a signal that a recession is up ahead. We inverted back in August 2019, which is why a lot of people thought that even without COVID, we would have hit a recession. But you can see the recession before that was the 2008, and we had inverted in February 2007. The recession before that was in the year 2001, and we had inverted in December 2000. So looking for that inversion now, and if we invert, then we will officially be in likely a broad-based recession. Some argue that we're in a recession now because we've had 2 back-to-back negative GDP quarters, but we will be in a more broad recession once that 10-year and 3-month invert. So there you have it, likely a technical bounce. I showed you the levels that I'm looking at where we will likely face our first point of resistance. Obviously, we are at the mercy of inflation and we are at the mercy of the Fed. So keep your eyes and ears peeled for September 13th and September 21st. Again, if you want access to all of our shorts, our plays, our day trades, our swing trades, our long-term investments, our analysis, you want access to the chat and everything that comes with it, the courses, the Zoom calls with me, it's a great value. Link is in the description. If you enjoyed this, give it a thumbs up. Let me know in the comment section that you enjoyed TA Tuesdays, TA Thursdays, and I will keep doing them for you because I love technical analysis. This channel started on technical analysis. But yeah, let me know that you love it and I will keep doing it. Anyway, traders, hit that thumbs up if you get anything out of this. Leave a comment. Stay safe out there, traders. Peace.